Lenders legally siphon your wealth every single day. You blindly hand them cash whenever financing necessities. This three-digit algorithmic kill switch systematically vaporizes your hard-earned capital, silently, automatically, every single billing cycle. CFPB data reveals a borrower with a 625 credit score financing a $400,000 home surrenders up to $264,523 more in total interest over the life of the loan. Meanwhile, top-tier borrowers mathematically dominate this unfair financial system. Paying these massive penalties makes early retirement nearly impossible and erodes your generational wealth. Hear me clearly. A low credit rating steals more than $9,000 from your wallet annually across mortgages, auto loans, and credit cards. This brutal financial bleeding ensures you will never achieve true freedom. Install the C.R.E.D.I.T framework today to stop the bleeding. This six-pillar system, starting with the credit leverage rule, automatically commands the lowest rates available. By the end of this framework, you will know exactly which pillar saves you the most money first. Unlock the 90-day strategic reset to reclaim your financial position. The content of this video is for educational purposes only and does not constitute professional financial advice. All investments carry risks. Write this acronym down. Here is the framework that fixes this. It is called C.R.E.D.I.T. C.R.E.D.I.T. 6 pillars, 1 system, 0 blind spots. This is architecture. Pillar 1, cost analysis. Every loan has 2 prices. The sticker price sits on the window. The real price hides in the interest. A $30,000 car at 760 credit costs approximately $34,400 over 5 years. The same car at 620 credit costs approximately $39,500. Same car, over $5,000 more. Here is how the sticker tricks you. You see $350 per month and think that is the price. It is not. The real price equals monthly payment times term times the rate multiplier your score unlocks. Lower score, higher multiplier. Same product, more money, every single time. You do not see this hidden financial kill switch on your bank statement, but you pay it every single month, on every loan, on every insurance premium, on every security deposit. The silent tax follows you everywhere, and the worst part, it compounds. Here is the lifetime math. Let me pause here. Over 30 years, someone with a 620 credit score can pay up to $200,000 more in interest across their lifetime than someone at 760. Same income, same purchases, same life. $200,000. That is a house. That is retirement. That is generational wealth, surrendered to a number you can fix starting today. Pillar 2, ratio engineering. This is your credit utilization. Forget the 30% rule you have been taught. It is a trap. The real optimization threshold is 10%. Below 10%, your score accelerates. Between 10% and 30%, it is like flat lines. Above 30%, it begins a steady and measurable decline. Here is the 10% rule in practice. You have a $10,000 credit limit. At 30% utilization, $3,000 balance, your score sits 20 to 40 points lower. Charge $1,000 instead, 10%, and your score can jump up to 30 points within 1 billing cycle. $10,000 limit, 30% utilization, $3,000 balance, score down 30 points. Same limit, 10% utilization, $1,000 balance, score up 30 points. That is a 60-point swing from a $2,000 difference. Not from paying more, from owing less at the right time. Pillar 3, error elimination. 1 in 5 credit reports contains an error, and roughly 1 in 20 contains a critical error, according to the FTC. Wrong addresses, duplicate accounts, paid-off loans still showing as open. Furthermore, under joint policies instituted by the credit bureaus, unpaid medical debts under $500 are entirely excluded from your report. Each error drags your score down. Each error you remove pushes it up. The system makes mistakes. You pay for them. Here is the dispute architecture. Pull your report from all 3 bureaus like Equifax, Experian, TransUnion. Cross-reference every account. Find every error. Dispute every error using certified mail. The bureau has up to 30 days to respond. If they cannot verify, the error disappears. Here is the federal protection you must use. Under the Fair Credit Reporting Act, if a bureau cannot verify a disputed item within 30 days, they must remove it. Not fix, remove. This is not a request. This is the law. That is architecture. Here is a move nobody talks about. The goodwill letter. You have a late payment on your report. It is accurate. You cannot dispute it. But you can write directly to the creditor asking them to remove it as a courtesy. Mail this directly to the executive office, not standard customer service. 1 letter, 1 stamp, a potential recovery that can salvage major points up to 100 off from your record. Here is another move. Become an authorized user on someone else's card, a parent, a partner, someone with a long, perfect payment history. Their positive history copies onto your report. You do not use the card. You do not need the PIN. You inherit their decades of on-time payments. You can also now legally report your monthly rent and utility payments directly to the bureaus to force a score increase. This is leverage.
You have 3 pillars: cost analysis, ratio engineering, and error elimination. 3 pillars that can move your score up to 100 points in 90 days. If you stop watching here, you leave the final 3 pillars on the table. These pillars are date discipline, inquiry intelligence, and timeline architecture. The second half changes your financial life. Let's dive in. Pillar 4, date discipline. Payment history is 35% of your FICO score, the single largest factor. 1 late payment, 30 days past due, can drop your score up to 100 points. 1. The higher your score, the harder you fall. A 780 credit score drops to as low as 660. The punishment is asymmetric. Here is the calendar architecture. Set every single payment to autopay. Minimum, not full balance, minimum. Why? Because autopay minimum guarantees you never miss a date. You can always pay extra manually, but the autopay locks the 35% factor. Date discipline is not memory, it is architecture. Here is what an 80-point drop costs you. Score drops from 760 to 680. Your mortgage rate can jump from approximately 6.7% to approximately 7.1%. On a $300,000 loan, that is roughly $80 more per month. Over 30 years, over $29,000 more. 1 late payment, $29,000. That is the cost of 1 missed date. Pillar 5, inquiry intelligence. Every hard inquiry can drop your score up to 5 points. A hard inquiry happens when a lender pulls your credit for a new application. 1 inquiry is a scratch. 6 inquiries in 6 months is a wound. I will show you the shopping window trick. Here is the shopping window. The credit bureaus know you shop around for mortgages and car loans, so they treat multiple inquiries for the same loan type within a 14 to 45-day window as a single inquiry. 1 inquiry, up to 5 points. Not 6 inquiries and up to 30 points. The window is your protection. Here is the trick. Apply for all your mortgage or car loan pre-approvals within the same 14-day window. Every pull count as 1 inquiry, up to 5 points total, not up to 30. You shop 6 lenders, you compare 6 rates, you pay for 1 inquiry. That is inquiry intelligence. This is architecture. Here is the distinction that saves your score. Hard inquiries hurt, soft inquiries do not. Checking your own credit, soft. A creditor pre-approving you without your application, soft. A landlord running your credit, hard. A credit card application, hard. Understand that the free score on your banking app is likely a Vantage score, while 90% of actual mortgage and auto lenders will only look at your strict FICO score. Because of this, always use pre-approval tools online, which universally rely on harmless, soft pulls before you ever submit an official application. Know the difference. Every hard pull is a tax on your score. Pillar 6, timeline architecture. The 760 threshold is the finish line. Below 760, you pay a premium on every dollar you borrow. At 760 and above, you access the cheapest money in the market. The threshold is not a number, it is a financial border. Here is why 760 matters. Below 760, conventional mortgage rates sit in the 7% plus range as of 2026. At 760 and above, rates drop to the mid 6% range. On a $300,000 mortgage, that spread is over $40,000 over 30 years. The threshold is not a number, it is a financial border. Below it, tax. Above it, leverage. Here is the 90-day sprint. Days 1 through 45, dispute every error on all 3 reports. Days 46 through 60, pay down utilization to below 10% on every card. Days 61 through 90, set auto pay on every account and let your payment history age. 3 months, 6 pillars, 1 score.
C.R.E.D.I.T. Credit is the architecture. C. Cost analysis. R. Ratio engineering. E. Error elimination. D. Date discipline. I. Inquiry intelligence. T. Timeline architecture. 6 pillars. 1 system. You analyze the real cost. You engineer your ratios. You eliminate errors. You discipline your dates. You manage inquiries. You architect your timeline. This is architecture. You have the C.R.E.D.I.T framework, but your credit score is not the finish line. It is the starting line. Now take 3 actions. Action 1, pull your credit reports from all 3 bureaus today. Do not use a paid service. Print all 3. Get a highlighter. Highlight every account you do not recognize. Highlight every late payment. Highlight every balance that looks wrong. This is your audit. Action 2, dispute every highlighted error. Do not do this online. While online portals are convenient, sending physical mail avoids binding arbitration clauses and creates a federally backed paper trail. Send a certified letter with a return receipt. This legally forces a human to investigate and creates a federally backed paper trail. If they cannot verify within 30 days, the law demands removal. Each removal restores real points to your score. Action 3, pay down your utilization to below 10% on every card. Not 30%, not 20%, 10. If your limit is $10,000, keep your balance below $1,000. Pay before the statement closing date, not on the due date, before. Never close your oldest accounts after paying them off, as credit age strictly dictates 15% of your total algorithm. This single action can raise your score up to 60 points within 1 billing cycle. You are no longer someone who has a credit score. You are someone who architects it. The wealthy do not fear credit. They leverage it. They understand the rules. They play by the rules. And they use the rules to build wealth while everyone else pays the silent tax. Type 760 in the comments right now. Make 760 a public target. The clock starts today. The second you type that number, you are not wishing. You are declaring. And the 90-day sprint starts the second this video ends. Your future will hold you to it. Here is the default path. You never check your score. You pay your bills late because you forgot. you drift. Your utilization sits at 45%. Your interest rates stay high. In over 30 years, you pay up to $200,000 more than someone at 760. Same income, same life. $200,000 gone. Or you take the architecture. C.R.E.D.I.T is the framework. Pull your reports, dispute the errors, engineer your ratios, discipline your dates, manage your inquiries, hit 760, and then use that score not to consume, but to leverage. This is not a credit tip, this is architecture. You are no longer just a borrower. You are a credit architect. Your score is not a judgment, it is a tool. Type architect in the comments right now. Don't just watch the future happen, build it.